Now, fund manager Liverpool Victoria Asset Management has released its latest appraisal of global asset class performance. And its chief investment officer, Piers Hillier, is here to explain who came out on top. Now, Piers, we actually made a bet in the newsroom if anyone could guess, and we pretty much got the general gist. It's equities higher, property overweight as well. But talk to me about Japan, because you have just upgraded equities in this country, which took some by surprise.
Yeah, that's right. And we've been underweight Japanese equities as long as anyone, I think. But I think we've seen some interesting things. I was there a month ago, and for me, what's changing is that there's an understanding from the Bank of Japan the need to actually provide some form of inflation in the system. So the target of 1% is a real one, and they're supporting that by buying equity ETFs and REITs, and that's a change. I think that's important in terms of supporting asset prices. Yes, I think the yen is clearly an issue, and certainly when we've taken that position on for UK investors, we've actually hedged our yen exposure. So we like the underlying fundamentals of the companies, but yen, obviously, yen strength is still an issue.
Now, the sovereign debt crisis in Europe hasn't had an impact really on equities. You expect it to continue not to have an impact, but you're worried about possibly extra hot money being put on emerging markets.
I think that's it. Essentially, we like the growth story there. It's really a question of the valuation. And I think you can buy emerging market growth actually through large developed markets and the companies that are there. I think people often underestimate that if you take the UK equity market as a whole, only less than 30% earnings come from the UK itself. A lot of that is derived from overseas. And so why corporate earnings have surprised on the upside this year in some ways has been supported by that growth. And I think what we see is a disconnect in valuation between emerging markets and developed markets. Now,
you're underweight, though, on fixed income. We have two key reports today in terms of GDP, the UK and the US. Will that sway your mind about anything if they come in better than expected?
I think it doesn't really. Our concern really with fixed income is actually you've got sort of inflation starting to creep into the system. And it's been evident in the UK for some time, and we flagged that for a long time, but you're starting to see in other markets as well. And so that's our concern, is that, yes, I think policyholders and policymakers are going to be on hold for some time because they want to make sure the economy is really recovering, but actually, we're going to start to see inflationary pressures in the back half of 2011 maybe cause interest rate rises to start to come onto the agenda for them, maybe sooner than some investors think.
But that will hurt equities once interest rates start coming up.
Yeah, I mean, generally speaking, if it's in a measured way, actually that supports equity valuations, because that gives a measure of policy setters. They're confident about the outlook for the economy and growth, and that, generally speaking, is good for equity.